I'm going to show you how to get an unbelievably high win rate. Now, the biggest problem with most high win rate strategies that you'll see online are that you might be able to get a high win rate, but the amount of money you make when you win is typically so small that all it takes is one big loss to come and wipe out all your profits and more. So I'm going to show you this one simple strategy step by step that I implement every single day into my portfolios that allows me to get a very high win rate and very high returns on capital. So the first thing you want to do is pull up a watch list of futures that have options contracts available to trade on them. And if your broker doesn't natively display a watch list like this, then copy down these ticker symbols and just make your own custom watch list. And then you want to also have IVR on your watch list, and you want to order everything from high to low IVR. And then at that point you'll be good to go. Now with futures, everything is always typically pretty liquid, so you don't really need to worry too much about the liquidity side of things. You mainly want to just focus on the actual product itself and the IV rank. Now we're going to be selling options contracts, which means that we want the value of the contracts to go down because we're going to be short. So we want to sell high, buy low. And when volatility rises, option prices rise, which is why we want to sell when volatility is high or when IVR is high, and then we can play the contraction back down to the mean or even further below, because volatility is mean reverting and it's contracting in the market about 80% of the time. So you want to pick an underlying, and you want to pick an underlying that has an IV rank of at least 30. So anything over 30 is good. And you want to pick something that's going to, number one, fit well in your portfolio in terms of being diverse. And number two, you want to make sure that it's going to fit in your portfolio in terms of position sizing. So if you do have a smaller account, you probably want to stick to things like currencies, bonds, soybeans, etc., things like that. If you have a larger account, by all means, you could trade anything you like. You know, crude oil is great to trade. However, it typically does require a lot of buying power. So just keep that in mind. However, I am going to show you a way of how you can reduce your buying power requirement, even if you do have a smaller account, but you want to trade a sort of larger product. Typically, things with lower IV levels will require less buying power because futures uses span margin, and IV is taken into account when calculating how much buying power is going to be required when using span margin. That's why things like currencies work quite well, and bonds. So we're going to use soybeans today, ZS. It has an IV rank of 53.3 and an absolute IV level of 35.6. So this is going to sort of be in the middle of the road. Can be okay for smaller accounts, can be okay for larger accounts. Just kind of depends on how small or how large your account is. Once you've selected your underlying, you want to pick an expiration date. This is an options expiration date that we are referring to. The one you want to pick needs to be between 30 and 60 days out in time. So there's one here, 35 days, April 25th. So we're going to open that up. And now we can see the options chain. So of course we have calls on the left, puts on the right. This horizontal orange line shows us where the price of the underlying is with respect to these strikes. Going down the middle, we have our expected move here shown with this vertical orange bar. We have our standard deviations, 1 and 2 standard deviations shown with the dotted blue lines. And very important, you need to have delta on your options chain as well for your calls and your puts. So what we're going to do here is we are very simply going to sell one call and one put. And when you're selling an options contract, you want price to stay away from that contract. So let's just go through an example of if we were to buy a contract and see how that would work. So let's just say we think that soybeans are going to increase in price, and we think that over the next 35 days, the price of soybeans is going to increase to 1,050. Okay, so what we might want to do is buy a call contract at 1020 here, expecting it to go to 1050, and then we're going to make the money in between 1020 and 1050. That's how it works if you were to buy a contract. Now, if you were going to sell a contract, it's the opposite. So we now want price to stay away from this contract. We want price to stay below 1020. So in this instance, if price goes lower, we win. If price goes stays sideways, we win. If price goes higher but not above 1020, we win. So we have a lot of win conditions here. If in the original scenario, if we're going to buy this contract, if price goes lower, we lose. If price stays sideways, we lose. If price goes higher but not high enough, we lose. So the odds are not in our favor here. So if we look at our pop in the bottom left, it's 36%. So if we were to buy this contract, we've got a 36% chance of making money here. If we were to sell the contract, we've got a 64% chance. So it's literally taking the opposite side of the trade. So very simply, we're going to sell one call, one put. Now, the further out we sell, the higher our probability of profit will be. Because if we know what the expected move is, which is this area here, and we want price to stay away from our contracts, we just need to sell outside of this expected move. That's going to give us a high pop. Now, the further out you go, the higher your pop will be, but the lower your return will be. Okay, so in my opinion, the sweet spot is to be between 15 and 20 deltas. So there's a 20 delta here on the call side at the 1050 strike, and there's a 21 delta on the put side at the 970 strike. So what we've done is we've created a range for ourselves between 970 and 1050, and we want price to be within this range or at the point of expiration. And the chance of being able to make money on this position is 59%. So our pop is 59%. Okay, that's if we hold until expiration. Now, we don't have to hold till expiration. We can get out at, say, 50% of max profit. And our P50, which isn't displayed for futures, it is for equities, but typically your P50 is going to be about 10 to 15% higher than your pop. So we would be looking at about a 70-75% chance of making 50% of profit on this trade. Now, you can also get out at 25% of max profit, and that's going to increase your win rate further to over 80%. And if you actually look at the numbers here, if we were to get filled at this mid price, we would collect $562 upfront in premium, and we're going to put up $2,700 in buying power. So as you can see, we are getting a very respectable return on capital with high probabilities of success here. Now, you might be thinking you want higher probabilities of success, or you want lower buying power requirements. Maybe you have a smaller account, maybe even if you have a larger account, but maybe this style of trading is new to you, you just want to you don't want to go all in just yet. That's absolutely fine. What you can do, and this only works with futures, unless if you have a PM account, then it will work with equities as well. But assuming you don't have a PM account, most people don't, it will only work with futures because of the span margin. What you can do is reduce your delta. So let's just say, so we're at 20 delta right now. Let's just say we take it all the way down to a 5 delta on either side. So we'll go to a 6 delta on the put side and a 5 delta on the call side. Now, what you'll notice is our pop has increased massively to 84%, meaning that our P50 is going to be over 90%, and our P25 is going to be even higher than that. Okay, we do collect less premium now because obviously we're taking on less risk. However, our buying power requirement has also reduced because we are taking on less risk. Our return has slightly dropped. We're now closer to 10%, but our pop in return has increased. So this is kind of how you can manipulate positions to fit in and around your portfolio, depending on how much buying power you want to allocate, so on and so forth. Now, speaking of buying power, you do need to have a systematic approach to your position sizing. So we've created a free position sizing template. The link is in the description. It's free for everybody to get a copy. And the way it works is you simply enter in the size of your portfolio. So say if it was $15,000, you can enter that at the top. And then below you can enter in whatever the current VIX level is. So say if it is 21.8. And then everything is going to be calculated for you. It's going to tell you exactly how you should be structuring your portfolio. And keep in mind, the numbers that it will give you are the maximums. Okay, so for example, the maximum amount of buying power to allocate to a single defined risk position in this example is 750. This is the maximum. Okay, that doesn't mean that you should be allocating 750 to every single position. It absolutely can be and should be lower in most cases. This is just the absolute upper limit, so keep that in mind when you are placing your positions. In this instance, this is your minimum amount. Obviously the minimum is the minimum, but everything else is pretty self-explanatory. It takes into account the size of your portfolio. It takes into account the VIX, which is in this instance is basically a proxy for telling you how much volatility is in the market. The more volatility or the higher the VIX, the higher our edge, so we can be more aggressive. Also, the higher the VIX, the lower the chance of a black swan event. That's another reason why we can be more aggressive. So just keep all of these things in mind. And as long as you're following this, you'll be absolutely fine over the long run. If you do want to learn in more detail about what we do and how we do it, the link for EDS Premium will be in the description. Just click on this button here and get yourself signed up. Once you are inside, you will have access to one of our portfolios that will allow you to see the positions that we place, how we manage risk, how we make adjustments, etc. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so you can speak with myself directly or with other like-minded individuals if you get stuck or if you just want to exchange ideas. There's a 100% money-back guarantee as well. So after 6 months, once you've been inside, follow the course, or been through the course, and followed some of our trades. If for whatever reason you are not profitable, then we will work with you for free until you are, or you can just request a full refund. So it is completely risk-free for you. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill. Once you've learned it, no one can take it from you. You've got it with you for the rest of your life. And we aim to get you to the point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.